Here to discuss it all is Alan Ruskin, Deutsche Bank Chief International Strategist, and Alex Dryden, JP Morgan Asset Management Global Market Strategist. Good morning to you both, guys.
Good morning.
Morning.
Alan, just to start with you, I mean, the general tone of the economic data, I would put it roughly as expected, but still in a slower kind of 2% zone for the U.S. and slower elsewhere. Are markets okay with this for the moment, given what central banks are up to, and trade perhaps at least has that carrot sticking ahead of the market?
Yeah, I think the market's a little concerned, really. I think there's a perception of a slowdown in momentum. Certainly in the manufacturing sectors, in terms of investment in GDP, that's soft. We know the trade picture globally is weak as well. So much is resting on the consumer. We've just had consumer expenditure data today. That's a little on the soft side. You're talking about consumer spending in Q3 now at about 2.4, 2.5%. GDP is probably only going to come in at 1.5%. That's a little bit too slow. Too slow.
Alex, we're obviously kind of pulled back from the brink of the kind of intense recession fears of August. Bond yields are up a bit globally, but kind of stalled out at these levels. So where does that take us, do you think, in terms of searching for a catalyst, a confirmation that you've seen some bottom?
Absolutely. I think we're dealing with a market at the moment that is uncertain about the pathway ahead. It's looking for a narrative. It's looking for a catalyst. We don't have a huge amount of clarity on what the Federal Reserve is going to do. They seem to be very divided as a committee, and that makes it hard to project forward as an investor. Meanwhile, on the trade front, who knows how that pans out in the next month or so? What about elections? What about Brexit risk? I think there's a lot of heightened uncertainty, so we're looking around for a narrative. What that means from an investor position point of view going into the fourth quarter, I don't think now is the time for big punchy bets. Hug your benchmarks, pull back on risk, wait for some sort of clarity, whether it comes from the economic data, whether it comes from the policy makers.
All the uncertainties you just mentioned, you didn't mention how the impeachment inquiry will impact either trade negotiation dynamics, right? Or policies and of any kind, really.
Absolutely. And this is the environment that we live in. We're in quite a polarized political environment. Geopolitical risk, not just in the United States, but in Europe, in the Middle East, in areas like China, is very elevated. Investors we're talking to are saying, look, I'm not sure which way this is going to go, and I'm frankly in completely the same camp. And therefore, now is the time to just pull back on some of those risks. Maybe one of the reasons why we're seeing US bond yields, despite ticking up slightly in the last couple of days, quite anchored down.
So are households mimicking now what corporate treasurers have been doing for a year?
Not quite yet. So the verdict's still out, but what we've seen is still in savings ratios bumping up in the latest data. Savings ratios are still quite high. So there's capacity for the consumer to still be there. But as you just mentioned, really, there's all these uncertainties really that are not going to be terribly helpful.
Uncertainties aren't helpful. In addition to everything we've mentioned, you've also got, as we just talked about, kind of the IPO indigestion in the market, the repo market stress that we've been observing for a couple of weeks. It just seems as if there have been more opportunities or excuses for the markets to back off even more than they have. I mean, how do you explain that they haven't, Alan?
Yeah, I think there's a lot of built-in resilience. I think the best explanation is just what's gone on in the bond market. The bond market has rallied so much. There's so much emphasis on what the Fed's done and what the Fed's going to do. But the bond market has eased so substantially for the Federal Reserve that I think that's provided flows back into the equity market and provide a buffer for risk in general.
And so is it just mechanical? Is that out? I mean, people also point to economic surprise indexes had perked up a little bit just because numbers coming in better than forecast.
Yeah, we are seeing that, but then sort of coincide that with what's happening outside of the United States. And we've got a global economic backdrop, particularly in Europe, where the region seems to be heading towards recession. PMI numbers across Europe seem to be quite weak for September. They were particularly bad in Germany. And this really goes back to the trade tensions. The United States and the Chinese economies look okay. But what has happened is those other countries, Germany, Korea, Taiwan, they've been caught in the crossfire. And that's where I think investors, both in the US and internationally, are struggling with. How does the US hold up in a weak or maybe even recessionary global environment?
So with global growth weak, right, investors this year have been taking gambles on high growth IPOs. Do you think that door is shut? What does it mean if that door is shut?
I think the door probably is shut, really. I think, just amping up the risk and the risk appetite is just not the way to go at this point in time. I think a more cautionary note is desirable. I think the kind of view that we've been putting forward is much more a case of just receive the front end of the curve. The Federal Reserve is going to do actually more than the market expects, and substantially more than the Fed's actually expecting in terms of its own dots.
Do more than they themselves expect. All right, Alex, we'll leave it there.
Thank you very much.
Thanks very much. Appreciate it.